I used to think I was a terrible trader. I'd watch my positions like a hawk, second-guessing every decision, closing winners too early, and holding losers way too long. My friends who barely looked at their portfolios were making money, while I, with all my research and technical analysis, was bleeding cash. Then, one night at 2 a.m., staring at red numbers on my screen, I realized something that changed everything. The market wasn't beating me. I was beating myself. Let me tell you about a study that absolutely wrecked my understanding of trading. Researchers at the University of California analyzed over 60,000 trading accounts. They found that the most active traders, the ones making the most decisions, consistently underperformed the market by about 6% annually. Meanwhile, people who traded less frequently did significantly better. Think about that for a second. The people who were supposedly working harder at trading were actually sabotaging themselves. This wasn't about intelligence or market knowledge. This was something deeper, something psychological that affects every single person who's ever clicked a buy or sell button. Your brain, as brilliant as it is, wasn't designed for trading. Evolution shaped our minds to survive on the African savanna, not to navigate financial markets. Back then, the cost of ignoring potential danger was death. If you heard rustling in the grass, you ran first and asked questions later. False alarms were fine. Missing a real threat was fatal. This survival mechanism created what psychologists call loss aversion, and it's absolutely destroying your trading account right now without you even realizing it. Loss aversion means we feel the pain of losing money about twice as intensely as we feel the pleasure of gaining the same amount. Win $1,000 and you feel pretty good. Lose $1,000 and you feel absolutely terrible, can't sleep, obsess over it for days. This isn't a character flaw. It's hardwired into your neural circuitry. But here's where it gets dangerous for traders. This emotional imbalance causes you to make irrational decisions that seem perfectly logical in the moment. Picture this scenario. You buy shares of a company at $50. The price drops to $40. Now you're sitting on a loss, and that loss hurts. Your brain starts playing tricks on you. You tell yourself you haven't actually lost money because you haven't sold yet. You convince yourself the price will come back, that you just need to wait it out. Meanwhile, the same company might have better opportunities elsewhere, but you can't see them because you're emotionally attached to getting back to break even. This is called the disposition effect, and studies show that traders hold losing positions an average of 70% longer than winning positions. The flip side is equally destructive. You buy that same stock at $50 and it jumps to $60. You're up 20%. Great, right? But instead of being happy, you're terrified. What if it drops? What if you lose these gains? Your palms get sweaty every time you check the price. Finally, you can't take it anymore and you sell, relieved to lock in your profit. 2 months later, the stock is trading at $90 and you're kicking yourself. This happens over and over, cutting winners short and letting losers run, which is literally the exact opposite of what profitable trading requires. There's a professional poker player named Annie Duke who wrote about a concept she calls resulting. It's when we judge the quality of a decision based on the outcome rather than the decision-making process itself. You make a trade based on solid analysis, but the market moves against you due to some unpredictable news event. Was it a bad trade? Most people would say yes because they lost money. But actually, the trade was good and you just got unlucky. On the flip side, you might make an impulsive, poorly researched trade that happens to make money. That doesn't make it a good trade. You just got lucky. Understanding this distinction is absolutely critical because if you judge your trading based on short-term results, you'll keep reinforcing bad habits and abandoning good strategies. Your brain is also terrible at processing randomness. We're pattern-seeking machines. We see faces in clouds and conspiracies in coincidences. In the stock market, this means we're constantly finding patterns that don't actually exist. A stock goes up 3 days in a row, and we think we've spotted a trend. We develop elaborate theories about market behavior based on limited samples. We remember our winning trades vividly and conveniently forget the losers. This is called confirmation bias, and it's why so many traders develop unshakable confidence in strategies that are essentially random. Let me tell you about a fascinating experiment. Researchers gave people a choice between two buttons. Button A had a 65% chance of winning money, and button B had a 35% chance. The optimal strategy is obvious. Just keep pressing button A. But people didn't do that. They tried to predict which button would win next time, switching back and forth, pattern hunting. Even when they were told the exact probabilities, they couldn't help themselves. They ended up winning far less money than if they'd simply stuck with the better option every single time. Traders do this constantly, abandoning proven strategies after a few losses because they think they can outsmart randomness. Here's something that might surprise you. Professional traders aren't necessarily smarter than amateur traders. Many successful professionals will tell you they're not even particularly good at predicting market direction. What separates them is emotional regulation and consistency. They've developed systems, and they stick to those systems even when every fiber of their being wants to do something different. They've learned to recognize when their emotions are hijacking their decision-making, and they have protocols to override those impulses. Think about how you feel when you're up money versus down money. When you're winning, you feel like a genius. You take bigger risks. You check your portfolio constantly, riding that high. This is the danger zone. Overconfidence leads to over-leveraging, taking on positions that are too large, ignoring risk management. Then, when the inevitable downturn comes, it's devastating. When you're losing, you feel stupid and scared. You might freeze up, unable to make decisions. Or you might do the opposite and start revenge trading, trying to make back your losses with increasingly risky bets. Both emotional states, euphoria and despair, lead to terrible decisions. There's a concept in psychology called ego depletion. Your willpower and decision-making ability aren't infinite resources. They're more like a muscle that gets tired. Every decision you make throughout the day depletes this resource a little bit. This is why professional traders often do their analysis and planning when they're fresh, typically early in the morning, and why many avoid trading when they're tired, hungry, or stressed. When you're emotionally depleted, you fall back on habits and impulses. You're much more likely to break your rules, chase losses, or make impulsive trades. The traders who make consistent money have learned to remove emotion from the equation as much as humanly possible. They treat trading like a business with systems and processes. They journal every trade, not just what they bought or sold, but how they were feeling, what their reasoning was, what was happening in their life at the time. Over time, they start to see patterns in their own behavior. Maybe they notice they make worse decisions on Mondays. Maybe they spot that they overtrade when they are bored. Maybe they realize they ignore their stop losses when they're feeling overconfident. Developing a trading plan isn't just about strategy. It's about building scaffolding to protect yourself from yourself. Before you enter a trade, you should know exactly where you'll exit if you're wrong and exactly where you'll exit if you're right. Not approximate ideas, exact prices. Write them down. Tell someone else if you have to. Because in the heat of the moment, when real money is on the line and your heart is pounding, you will rationalize breaking your own rules. Your brain will generate incredibly convincing arguments for why this time is different, why you should give the trade more room, why you should take profits now instead of waiting for your target. One of the most powerful things you can do is build in friction between impulse and action. Professional traders often have elaborate checklists they must complete before entering a trade. Does this setup match my strategy criteria? What's my risk-reward ratio? What's my position size based on my risk parameters? Am I emotionally compromised right now? Is there any reason this might be a revenge trade or an attempt to recover losses? These questions force a pause, a moment of metacognition where you're thinking about your thinking. That pause is often enough to stop a terrible decision. The concept of tilt comes from poker. It's when a player loses emotional control and starts making irrational decisions. They get angry about a bad beat, and suddenly they're raising with terrible hands, calling when they should fold, completely abandoning the strategy that normally makes them money. And traders tilt all the time. You take a loss that hurts, and suddenly you're looking for any reason to get back in the market. You see a setup that kind of looks like your strategy but doesn't really meet your criteria, and you take it anyway because you need to make back what you lost. This is psychological quicksand. The more you struggle, the deeper you sink. There's actually a biological component to all of this. When you're trading successfully, your brain releases dopamine, the same neurotransmitter involved in addiction. You get a hit of pleasure from winning, and your brain wants more of it. This can lead to overtrading, taking marginal setups, increasing position sizes beyond your risk tolerance. You're literally chasing a chemical high. On the other side, when you're your body floods with cortisol and adrenaline. You're in fight or flight mode. Your thinking becomes rigid and narrow. You can't see the bigger picture. This is why the advice to take a break when you're on a losing streak isn't just folk wisdom, it's neuroscience. Some of the best traders I know have rules about walking away. If they hit a certain loss threshold for the day, they're done. No exceptions, no negotiations, no just one more trade to make it back. They'll literally close their trading platform and go do something else. This isn't admitting defeat. It's recognizing that they're no longer in an optimal state for decision making. Similarly, many traders cap their wins for the day. This sounds counterintuitive until you understand the psychology. When you're on a winning streak, you often start to feel invincible. That overconfidence is dangerous. By walking away when you're up, you lock in gains and avoid the common trap of giving back profits with increasingly risky trades. Position sizing is another area where psychology trumps analysis. Most traders know intellectually that they should never risk more than a small percentage of their account on any single trade. Let's say 2% is your rule. But when you really believe in a trade, you bump it up to 5% or 10%, because this time you're sure. This is the setup you've been waiting for. Your conviction is sky high. And maybe that trade works out. But the one time it doesn't, you've just blown a huge chunk of your account. The math of trading is brutal. Lose 50% and you need to make 100% just to get back to break even. Consistent, small position sizes aren't exciting, but they keep you in the game when you're wrong. There's an illuminating study about financial advisors and their own portfolios. You'd think these professionals, who help other people manage money for a living, would have optimally constructed portfolios themselves. They don't. Many financial advisors have poorly diversified portfolios, hold losers too long, and make emotional decisions with their own money. Even though they know better, even though they would never advise a client to do what they're doing, they can't help themselves. This should be humbling. If professionals who are steeped in financial knowledge can't overcome these psychological biases, what hope do the rest of us have? The answer is systems and self-awareness. The traders who survive long enough to become profitable are the ones who embrace their own irrationality. They don't try to become emotionless robots. That's impossible and probably counterproductive. Instead, they study themselves as carefully as they study the markets. They notice their tendencies. They spot their patterns. They identify situations where they're likely to make mistakes, and they build guardrails. Maybe you know you're impulsive in the first hour of trading, so you have a rule never to trade in the first hour. Maybe you know you overtrade when you're bored, so you make sure you have other engaging activities available. Maybe you know you become obsessive when you're losing, so you set hard rules about how often you can check your positions. The concept of sunk costs is particularly relevant here. Once you've invested time, money, or emotional energy into something, you feel compelled to continue, even when it no longer makes sense. You bought a stock, it went down, you averaged down, It went down more, and now you're so deep into this position that selling feels like admitting total defeat. The money you've already lost is whispering in your ear, telling you that you can't give up now. But that money is gone. The only question that matters is whether this position makes sense going forward. Would you buy this stock at this price if you didn't already own it? If the answer is no, you should sell. The sunk cost is irrelevant, but your brain makes it feel vitally important. Social pressure and external validation play huge roles too. When you tell people about your trades, you become invested in being right. Nobody wants to admit they made a mistake, especially publicly. So you hold losing positions longer than you should because selling means admitting you were wrong. You might even add to losing positions, doubling down on your public prediction. This is ego protecting itself at the expense of your capital. The best traders keep their positions private. They don't need external validation. They're comfortable being wrong because they know being wrong is an inevitable part of trading. They take their losses quickly and quietly, without drama or justification. Media consumption is another psychological trap. Financial news is designed to provoke emotional responses because emotion drives engagement, and engagement drives advertising revenue. Every day, there's a new crisis, a new opportunity, breaking news that demands immediate attention. This creates a sense of urgency and FOMO, fear of missing out. You see a stock soaring, and you feel like you need to get in before it's too late. You hear about a market crash, and panic drives you to sell. But here's the thing. Most news is noise. The information that's actionable for traders is usually already priced into the market by the time it reaches mainstream media. Reacting emotionally to headlines is a fast track to poor performance. Successful traders often limit their media consumption or consume it strategically. They're not watching financial television all day, getting whipsawed by every talking head's opinion. They have specific sources they trust for specific types of information, and they know how to filter out the noise. More importantly, they've developed the psychological discipline to process information without immediately acting on it. They can hear about a compelling opportunity and still take time to analyze whether it fits their strategy rather than jumping in impulsively. The concept of mental accounting is fascinating and destructive. People treat money differently depending on where it came from or how they think about it. Money you earned from working feels different from money you won gambling, even though money is money. Traders do this all the time. They might have strict risk management rules for their serious trading capital, but then they win big on a trade, and suddenly that profit is house money. Each that they're willing to risk more aggressively. Or they keep their gambling trades in a separate account from their investment trades, even though it's all their money. This arbitrary mental separation leads to inconsistent decision-making. Let me give you a practical example of how psychology destroys trading accounts. You start with $10,000. You make 10% on a trade, now you have 11,000. Great. Then you lose 5%. Now you're at 10,450, still ahead. But psychologically, you don't feel ahead. You feel like you lost money. You had 11,000 and now you have less. That loss stings. Even though you're objectively profitable, this emotional pain might cause you to take a risky trade to get back to 11,000 quickly. That trade loses another 5%. Now you're at 9,927, actually down from your starting capital. The emotional cycle intensifies. You're not just trying to recover recent losses. You're trying to get back to break even. The hole keeps getting deeper because you're making decisions based on emotional states rather than objective analysis. Breaking this cycle requires radical acceptance of loss. Not every trade will work. In fact, a trading strategy that wins 60% of the time is considered excellent, which means it loses 40% of the time. If you can't emotionally handle being wrong 4 out of every 10 times, trading will torture you. The traders who make money don't win more often necessarily. They just make more on their winners than they lose on their losers. They cut losses ruthlessly and let winners run, which is psychologically backwards from what feels natural. Here's a mental reframe that helps some traders. Think of losses as the cost of doing business. A restaurant pays for ingredients, some of which will spoil. A retailer pays for inventory, some of which won't sell. A trader pays for opportunities, some of which won't work out. If you ran a business that was profitable overall but got emotionally devastated every time you had an expense, you'd be a wreck. Losses in trading are expenses. They're the price you pay for the winners. Once you internalize this, losses become less emotionally charged. You can take them objectively, record them, learn from them, and move on. The journey to becoming a profitable trader is really a journey of self-discovery and self-mastery. You'll learn things about yourself that you didn't know and probably won't like. You'll discover you're more impulsive than you thought, or more stubborn, or more fearful. You'll see how your mood affects your decisions. You'll notice patterns in your behavior that you've probably repeated in other areas of your life. Trading is like a mirror that reflects your psychological weaknesses back at you with perfect clarity, because there's an immediate, objective scoreboard in the form of your account balance. The good news is that these psychological skills are trainable. You can get better at recognizing your emotional states. You can develop protocols that protect you from your worst impulses. You can build discipline through repetition and accountability. Many successful traders work with coaches or trading psychologists, not because they don't understand the markets, but because they need help managing themselves. Some keep detailed journals where they write about their emotional state before, during, and after trades. Some meditate or exercise to regulate their nervous systems. Some use accountability partners who they have to check in with before taking trades. What doesn't work is thinking you can power through with willpower alone. You can't. Your brain is too powerful, too subtle, too skilled at rationalizing what it wants to do. You need systems, not superhuman discipline. You need to design your trading process so that doing the right thing is easier than doing the wrong thing. You need to make impulsive trades difficult and well-planned trades straightforward. You need feedback loops that help you see when you're going off track before you've done serious damage. At the end of the day, profitable trading isn't about finding the perfect indicator or the secret strategy. Those things matter, but they're secondary. The primary challenge is managing the space between your ears. It's about recognizing that you're a human being with evolutionary baggage that's poorly suited for financial markets, and building scaffolding to support yourself anyway. It's about being honest when you're wrong, humble when you're right, and disciplined all the time. It's about understanding that the market doesn't care about your feelings, your needs, or your opinions. It's entirely indifferent. The only person who can protect your capital is you. And protecting it often means protecting it from yourself.